Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. I will introduce the source material before each segment. We're going to start off very good research on liquidity, as usual, from cross-border capital. And some of you may recall that there was an adjustment by the Bank of Japan 2 or 3 weeks ago to their yield curve control policy, and they raised the ceiling on their 10-year government bond yield from 50 basis points to 1%. So from 0.5% to 1%, widening the target. And that is, according to cross-border capital, threatening to roil international bond markets. We estimate that JGB yields could break 1% and US Treasury 10-year bond yields could test 4.5%. And of course, that has implications for world bond markets. World bonds are highly correlated, and some effect will be felt in international markets. Implies a bearish steepening in the US Treasury curve and 10-year yields testing 4.5%. So bond yields are all important, particularly the US 10-year yield. It is the benchmark for pricing all financial assets across the world. And then liquidity, also cross-border capital. The global liquidity index fell back to 16.5. That's a range from 0 to 100. So 16.5 is quite low. So it fell there at the end of July from 20.9 in June. The setback gives the lowest reading since January. The fall is largely down to weaker private sector liquidity, dropping from 31.5 to 25. Weaker cross-border flows, dropping from 56.9 to 44.4. Central bank liquidity also fell back a tad from 23.6 to 21. So tactically, this air pocket in global liquidity convinces us to take some risk off. Worryingly, global liquidity is faltering at a time when the risk exposure of investors has climbed back to moderately high levels. However, we hold to our strategic view that the global liquidity cycle bottomed last October and will not peak until early 2026. So this is really, as Michael Howell said, just an air pocket. World central bank liquidity is likely to ease substantially over coming months. Okay, so gathering bond market tensions, that's what he talks about. Our latest estimate points to a fair value on US 10-year bonds of nearer 5.5%. Note, this is not a forecast, but a warning. So why is it that the US 10-year bond yield is moving up? We've heard already about Japanese yield curve control adjustments. That adjustment could lead Japanese government bonds to retest the 1% yield level at the 10-year tenor, and so force Japanese funds to shift from US Treasuries back into JGBs. On top, credit rating agency Fitch, their recent ill-timed and ill-informed decision to downgrade US sovereign debt has proven a further nail in the US Treasury coffin. More nails are on their way. The equally troubling fact is that US tax revenues are now slipping and the prospective US fiscal deficit is growing in size, causing a recent jump in US Treasury bill issuance. It's quite worrying. We can see the US 10-year Treasury bond yield nudging past its previous medium-term peak of 4.2%, and I think that's why we are not going to hesitate in raising a bit of cash for the portfolios. This troubling bond yield message is echoed by MRB. They say the following: the latest macro data is sending a clear message that interest rates and or bond yields will ultimately need to move decisively higher before the economic expansion becomes threatened. This is especially true for the leading US economy. And then what about the UK economy? This is what we have identified as being the port of call for raising some cash in the portfolios. As we have regularly noted, not all developed economies have the same household sector fundamentals as the US and Euro area. Our list of weak links all have sizable housing bubbles and household sector debt imbalances, which makes them considerably more interest rate sensitive. These developed economies are prime candidates for future housing busts and prolonged deleveraging adjustments as the world shifts to a higher interest rate environment. So the UK falls in that category, making it an obvious candidate for raising cash. So now for the good news, disinflation is occurring. This is from Capital Economics. Signs of easing price pressures continue to gather. In the US, headline CPI inflation has fallen from a peak of 9.1% in June last year to 3% currently. Inflation on the Fed's preferred PCE measure, personal consumption expenditure measure, has fallen from a peak of 7% to 3%. And month on month increased by just 0.2% in June. And it's not just declines in food and energy, there's a broader easing in price pressures. Core PCE inflation is now running at 4.1%, down from a peak of 5.4%. Month on month in June, rising by just 0.2%, having posted average monthly gains of around 0.4% over the prior 6 months. And this is not just a US story. Headline inflation has been slower to fall in the Eurozone and in particular the UK, but even there it now appears to be on a downward path. The recent run of good news on inflation has come against a backdrop of extremely strong labour markets. Part of the answer is that the pandemic and the war in Ukraine caused one-off shocks to the level of prices of everything, from food and energy to used cars, that is now passing through the system, echoing the period after the Second World War. So what of the future? Capital Economics conclude our long-held view has been that inflation would fall without the need for a recession, and to the extent that a recession was likely, it would be a mild one. Our conviction in our recession call has perhaps fallen a bit in recent months, but our conviction in our inflation call has strengthened. The bigger challenges will come in economies where supply-side improvements have been slower to materialize. Chief amongst these is the UK. So we can see a bit of a theme building here. Finally, a little bit more on inflation, also from Capital Economics, specifically relating to the non-farm payroll data and average hourly wage growth, increased in July by 0.4% month on month and 4.4% over the past 12 months, might seem like a problem for the Fed. But with productivity growth accelerating, it may not be. Productivity is finally beginning to improve, and probably with AI will improve even further. Productivity increased at a 3.7% annualized pace in the second quarter. That's an incredibly strong figure, and is up 1.3% over the past 12 months. With nominal wage growth slowing and productivity growth normalizing, growth in unit labor costs has slowed considerably. Unit labor costs increased at a muted 1.6% annualized pace in the second quarter, and they are up by 2.4% over the past 12 months, consistent with overall core inflation dropping to 2% on a sustained basis. What does all this mean for the Fed and the interest rate outlook? Also, again, from Capital Economics, we think disinflationary pressures will help the Fed pivot to rate cuts sooner than investors expect, giving a boost to safe assets later this year and next year. Inflation will fall more quickly than the Fed expects, almost irrespective of how the economy holds up. Investors are still underestimating how far the Fed will ultimately cut rates over the next couple of years, and after the brief hiatus in the 10-year US Treasury bond yield, we are sticking with our forecasts for the 10-year Treasury yield to fall to 3.25%.
Nick, thank you very much for interesting global macro overview. It's very interesting to hear that. I think it deserves a wider audience, actually. Firstly, AB InBev. We own AB InBev, and earlier this month it reported earnings per share of 137 US cents. That is for the 6 months to the end of June, and that's an increase of 3%. This was a solid result, with the growth coming in ahead of expectations, and it was also the revenue was in line with management's guidance, which provided further comfort. And AB InBev, this price, they offer fair value with a forward PE of 17.5 times and a forward dividend yield of more than 2%, about 2.1%. Then Glencore, I've mentioned Glencore before here, but there's more information available now. They announced the results for the first half of the financial year. Their financial year ends in December, so this is the first half up to June. And their earnings have taken a lot of pain. There's actually no mining group that is safe from the negative move in the mining cycle this year. In many cases, the headline earnings per share of miners are down by more than 50%. Glencore's earnings fell by 58% year on year. That is for the first 6 months of the year. And we must remember that this 58% drop comes in of a very good year last year. Last year was a record year, and this past 6 months was actually the second best 6 months ever. So although it's down 58%, it's still a very good figure. Their focus is on transition metals or green metals like aluminium, nickel, and copper. And the acronym for this aluminium, nickel, and copper is the ANC. So they are the ANC of commodities. The balance sheet is strong even after this drop. There's lots of cash, and there will be a dividend. Glencore actually distributed more than 9 billion rand to shareholders this year, and they expect the second half of the year to be much better. MTN, we own MTN. There was an announcement yesterday that MasterCard of the USA, the payments giant, will take up a minority interest in MTN's fintech business. That is fantastic news, and MTN's market cap gained 12 billion rand on news of the tie-up with MasterCard. MTN has got mainly three income streams, which is voice, data, and fintech. And the expectation is that as fintech, as it develops, it will actually spin off from the voice and data. So the MTN will remain on the stock exchange with the voice and data, but there will be a second company with fintech interests. The results for MTN, as for the 6 months, it was announced that the diluted earnings per share climbed from R4.33 last year to R5.01 this year. That's an increase of 15%. They have got problems in Africa. The main problem is the inflation rate in Africa, especially in Nigeria. The inflation rate is 22% and the interest rate is 18.75%.